I think we're talking with the panel today is about maybe the most interesting topic when it comes to digital banks, their path to profitability. I think I've just heard one of the numbers that have been shared around less than 5% of the digital banks being profitable. I'll share a quick update on that in a moment. Before that, I'm glad I'll be joined by two members of the business that have actual experience in moving towards profitability at different stages of the profitability life cycle. Thanks, Sid and Gabby, for joining. Maybe before I hand over and give the word to you, I do want to give you a couple of more numbers on the state of the industry. So my name's Christoph Stegmaier. I'm one of the senior partners at Simon Kucher, and we do an annual study on the neobanks. And out of those 400 neobanks, as you've just heard, there were about 5% of them being profitable. Our tagline was always, neobanks are very good in growing. They have about 1 billion customers worldwide are with neobanks now, but only 5% are profitable. So they're good at growing, but they're bad at monetizing their customers. The update to that number is actually that we've just looked at 30 of the largest neobanks, and there's now 6 of them profitable, one of them being Revolut, which is why I'm quite interested in hearing Sid's perspective on that. And so I'll hand over, maybe starting with you, Gabby. Can you give us a bit of background on yourself, on your organization, H.M. Bradley, and where you're on the profitability life cycle?
Sure. So my name is Gabby, and I have touched pretty much every financial product that exists under the sun, seen the good, the bad, the ugly at Citi, Fannie, Amex. And now I'm at H.M. Bradley, which was on track to break the top 1,000 banks in the United States 2 years from launch, up until the moment that our partner bank at the time put the brakes on growth, told us to literally shut down, stop acquiring new customers, and it nearly knocked us out. But I'm here because we're on a path to profitability. We're not there yet, like Sid, but we're on a path because of the decisions that we made in the last year where we recovered. We relaunched our products, which are a high-yield checking account and a card account. We re-platformed with Thought Machine, so we're the first bank in the US to do that, which allowed us to launch a new product category called Routines, which automates money transfers and could very virtually, very literally make pretty much any fintech app on your phone obsolete. So for a variety of different reasons, we were able to make it through what could have killed a lot of different fintechs. And in terms of life cycle, last year we were able to pivot to positive unit economics, which is the foundation that you need to profitability. And then with scale, we can get there. We can break even and pay our own bills instead of getting fundraising.
Thanks, Gabby. Hello, everyone. I'm Sid Jajodia. I've been in banking now in one way or the other 20 plus years. First 10 years was at Capital One, and since then I've been on the other side, the fintech trade. First at Lending Club, then for an emerging markets focused company out of Netherlands, and then for the last couple of years at Revolut. Revolut, for those who are not aware, I'd encourage each of you to download the app and try it. Revolut's a financial super app. So what does that mean, financial super app? It just means one app where you can do all the things as a consumer you may want to do. So the products we have today globally are not just your typical payments account, but we also launched credit in 6 countries. We are in 40 countries. We have 30 million customers. As Christoph said, we're profitable. This is the 8th year of our journey. And the other product set, beyond just payments and credit, you can trade crypto, you can trade equities, we're launching a robo-advisory product soon. And the objective is to eventually be a place where any consumer or small business can do all things money related on that one app and do it in a better way than your traditional bank would allow you to do and at a better value. So at the end of the day, if you solve for building the right product that a customer cares about, delivering value in a way that's clearly differentiated, you don't have to pay for growth. The product sells itself. As long as you're disciplined about it, there's no reason why you can't be profitable as a neobank. But the focus needs to be on product market fit to begin with, and then scaling from there.
Thanks. I think you're already touching on that million-dollar question around the key to profitability, which is also the name of our panel today. Maybe Sid, just staying with you a bit more because you have figured it out how to become profitable. You mentioned product market fit. That's probably the hygiene factor number 1 around making profitable. What other factors? What are your top 3 elements on profitability? What do digital banks have to get right in order to become profitable?
That's a fairly open-ended question, Christoph. It depends on what your strategy is, and I don't think it's a one-size-fits-all for everyone. Like, I'm sure Gabby, who's focused more on the high end of the market, will have a different perspective given the nature of their strategy. For us, we're building a bank that is inclusive, that gives anybody access to all the services. It's not designed for a niche. For us, it was critical first in our home market to build a product that people care about, right? And in the UK, we launched initially a card, a spend card, but also a wallet in which you could hold up multiple currencies. Today, you can hold 30 currencies, but you can trade close to 100 or make payments in close to 100. And that took off on its own. So we didn't have to spend to acquire customers. If you have a product that is not differentiated and you're spending a lot of marketing dollars to acquire customers, that doesn't necessarily lead to short-term sort of direction of profitability. So I think it's critical to A, have a differentiated product, solve for it in your market, and then expand. And expansion goes two ways for us. It's both on the product side. I talked about the variety of products we have, but also globally. So we've launched in 40 countries. Our objective is eventually to be close to 90, at least, as we look at the globe on where we want to be in at least a light touch way of serving customers, and do all the products that customers care about that we think mathematically makes sense. So I think core is, first thing is product market fit, achieving the flywheel where customers are selling your product, being very disciplined on cost, whether it's marketing, whether it's expansion, very, very sort of focused and disciplined on cost. And then the last, when the time is right, you then reinvest in the business and focusing on payback. So when you are spending marketing dollars, are you getting paid back in 18 months? Or are you taking 5 years to get paid back? I think that discipline, again, is critical for profitability.
Yeah, I would agree with all of those, actually. The only point which is very Revolut specific, I think, is that your ambition to grow into 90 countries, that's not necessarily something we would recommend sort of for as a key driver of profitability. But for you, I think it's your unique selling proposition, which is very important. Gabby, from your perspective, you have a bit of a different angle to this. What's important for you? What's important for H. Bradley right now on its path to profitability?
I mean, it's a similar foundation, I would say, but what's different about H. Bradley is we are more of a niche bank. So we built our entire proposition on attracting savers. We priced for savers, we built our brand around savers, and in doing so, we've attracted savers. So there's concentration. Positive unit economics is the foundation. Getting there last year was major for us because now with scale, we can break even as soon as we hit $1 billion in deposits, which we're on track to do. I would say the second, flywheel is a word for it, efficient momentum. I mean, anecdotally, when we launched, we were one of the first out there throwing 3% interest when everyone else was at 0%. $1 of advertising was going to bring in $1,000 of deposits. So it was just really efficient. It was selling itself. We had a wait list, and the capital that the customer held was, did they have a ticket that could invite somebody in when we had to shut down that growth? So efficient momentum in scale is huge, and that means that you have discipline in product, discipline in marketing, and a playbook that you can replicate that has a low cost of acquisition. And I would say the last one is anticipate. Where is your competitor base going? Where are your customers going? And are you just going to launch a product that's like everything else and compete and race to the bottom on pricing? Or are you going to do something differentiated? That's something that we've thought a lot about. And last year when we were in a very prickly situation, investing engineering in a new product category that doesn't really exist anywhere else, routines, it was a bet that there was going to be price competition and we needed something differentiated, a value to the customer that makes life tangibly easier, that we can compete with, and that we're not competing with anyone on that.
I actually want to double down on that last point you said and Sid's point you said about how important it is to have that product market fit. I would like to refer to it as a product market price fit, where when you have innovation, quite often you test innovation with your consumers, and the consumers would always tell you, that's great, I want to have that. But if you test the same innovation and you put a price tag on it, your answers might be completely different. So getting innovation right, but also setting the right price for that innovation is important. How important is pricing for you? And Gabby, I think you mentioned sort of the deposit and lending side of that. What role does it play for you?
I mean, critical to the story. Again, when we came out of the gate, 3%, offering 3% when everyone's at 0%, it's burning cash. And we knew that. The goal was grow deposits with customers that you can lend to. And so what I would say is the premise to everything is price your product and pay for the behaviors that you want that take you to the path of profitability. So for us, a customer gets the highest APY. Right now we're at 4.5%. If that customer is all in with H.M. Bradley, do they have recurring balances and direct deposits? Most of our customers do. Do they use our credit card? Most of our customers do. Do they have positive cash flow, meaning they save more than they spend? Where the bank for savers, that's a really important value for us. Most of them do. When you have that ecosystem, our pricing allowed us to grow our customer base and deposits to a point of just sticky retention. That is how we were able to survive what could have been a fatal blow to most companies and migrate most of these customers to a new sponsor bank. Because we invested in the pricing, we knew that it was not profitable then to grow a moat around the customer, but in exchange for sticky behaviors. And that has been protective to us. And now that we have positive unit economics, the strategy will pay itself off, basically.
It's an interesting question, Christoph. So yes, I mean, you can build a product that everybody likes, but if you can't get them to pay for it, that's a problem, right? For us, we've taken the approach of segmenting the market at various price tiers. So we have a free plan where you can do all of these activities, but there's caps to it, and above that, we start charging you for it. And then we have multiple subscription tiers, and for each of those tiers, you get more volume capability. So you can trade more currency, you can get more ATM transactions for free. And what we've seen is customers self-select into the tier that makes sense for them based on their own volume expectations and their need. If you're going to move a lot of money internationally, you may want the Ultra plan or the Metal plan, which is the highest tier, and be willing to pay for it. And if your needs are fairly modest, you can adopt the free plan. And what we've seen is customers look at the bundles, they figure out what makes sense for them. As long as the bundles are priced in a way that the value you're delivering is a better value than the market, the customers will come, they'll self-select, and you get paid for it. So our model is a little bit like what you see with Prime at Amazon, right? So customers pay us a flat fee every single month, and in exchange, they get the value that they're looking for.
Yeah, this is already an advanced model, and I think you have the benefit of having multiple product categories that you're actually selling to your customers, which allows you to segment and differentiate better your customers. I think a lot of the digital banks that have grown to this 1 billion customers, they have started out by getting the customers for free. So that type of freemium model has been not working really well because the free-to-fee step is a very difficult one. And if you have more things that you can monetize and validate, that sounds like an important part of the profitability strategy. Another part that I wanted to focus on with the two of you is the role of lending and the role of building an actual balance sheet. 50% of the neobanks globally have lending already included. Actually, 100% of profitable neobanks have lending, which means there's no neobank out there that does not have a lending business. How important is that role of lending for you? Maybe Sid, if you want to start with that.
Sure. If I take the customer view first, whether it's a consumer or an SME, the three basic needs they have are save, spend, and borrow. If you're going to be a bank that aspires to have a long relationship with a client, you have to be a credible lender. Otherwise, your relationship with the consumer is limited, and therefore they're going to be building relationships with others. So first of all, I think just lending is a critical component of serving the customer. In terms of profitability, I think, as we were having a conversation just before we got on stage, I think if you look at the neobanks that lend versus the neobanks that don't, you're going to see revenue per user dramatically different. Now, that comes with a catch. Balance sheet lending is capital intensive, right? So if you you can go at it two ways. The way Capital One went at it years ago, 20 years ago, or New Bank went at it, which is start with lending, build a profitable lending business, and then launch other products. Or you find some other product where you can build the product market fit, get scale, get the borrowers in, understand the user's needs, and then start lending to them on the backs of the data that you collect. So we've taken that approach where we've scaled fairly quickly in the first 5-6 years. We launched lending a couple of years ago. Now we're lending in 6 markets, soon to be by the end of this year, 11 markets. And it's a critical component of our business. In Europe, where we are a bank in 29 countries, we have north of $10 billion in deposits. The way to make the spread on that, throughout cycle, not just when sovereign debt is at 3 or 4%, but through cycle, you need to have a lending business to be able to monetize that deposit base and generate a spread on it.
Yeah, I mean, couldn't agree more. Lending is part of our DNA. We actually have patent pending application process called one-click credit, where a customer, as they're getting approved to get the bank account, which is the shiny interest rate that they might want, they have to opt into one-click credit, which allows us to always do a soft pull and pre-qual them for any product, any lending product that we have. And 60% of the time that when we offer a credit offer, 60% of the customers accept it. So we're able to intercept them. Our goal has always been grow deposits with people that you can lend to. And having this interception at the very beginning that allows us to always constantly scan and qual the customer as we start launching new products allows us to be in a position, for example, maybe next year we can have a pre-approved refi rate because you have been a saver with us. We can see your card behavior, and many of our customers often behave like charge customers. They pay it down at the end of the month. But these are great customers that you can lend to. So thinking about having a portfolio of lending solutions as we grow was always part of our DNA, and that's why we built it into the flow of how you become a customer.
Very interesting. I think we all agreed lending is an important role in the path to profitability. There's a few others. I think we have about 2 minutes left. I don't know if there's questions in the audience. So we'll open up also if you wanna scan and send us your questions. While we're waiting for that, maybe 1 or 2 quick questions. Or a very quick answer from your side. Rising interest rates, good news or bad news for digital banks?
Great news for us. So as I said, we came into this environment with a very fast-growing deposit base without a lending book. So if you don't have a lending book to start with, you don't have the mark-to-market losses or even the unrealized losses that a lot of the banks face. So great news for us because now we have this deposit base we can deploy in a higher interest rate environment and generate fat spread. So generally positive. I think 2023 is going to be a very profitable year for Revolut as a result of that.
It's great news for us too. Big banks with big back books can't afford to have the rates as high as we can. And we will be able to hold our rates longer than other players as they start to everyone's going to bring everything down, but we'll be able to hold higher for longer because of our sticky customer, our long retention curves. We can just hold the position longer, which is beneficial for us.
Okay. Second question. Apple moving into the deposit space, billions in the first week, scary or potentially an opportunity?
Pushes others to start thinking the way we've been thinking.
I think Apple, by just the fact of its installed customer base, is one of the greatest distribution channels you can find. So great for Goldman, great for any other bank that partners with Apple. On the flip side, Apple will not open up that platform to generate sort of fintech relationships to anybody and everybody. So you have to have the right scale, the right balance sheet strength, the right credibility for Apple to partner with. So it does sort of create a bit of a challenge in the market for others. If all you're leading with is price on deposits, Apple will probably not be the best price in the market, but it has the best ability to sort of soak up a lot of the price-sensitive deposits in the market. So scary for anybody who's leading just with deposit pricing, but otherwise, generally interesting as a distribution channel.
Okay, very good. So we don't have to be scared. We'll take it as an opportunity. Any last words? We're running out of time. Anything the audience needs to know?
Any questions from the audience? No. Okay.
I mean, we can't control for a bad actor that calls attention and does things the wrong way, but I can say that at least at H.M. Bradley, controls are important. They're core to how we operate, and we have a lot of experienced people who have taken the best practice of regulated institutions, and we operate like we are. There's no corners that we're cutting. So I think that as long as your processes are clean, even if regulators step in, you shouldn't. There shouldn't be a risk if you're following the rules. So I don't anticipate anything, but then again, never say never.
My perspective, Revolut is a bank in 29 countries in Europe. We aspire to be a bank in most of the markets we will participate in. We're a licensed broker-dealer in the US. We are a registered advisor for the purpose of launching a robo-advisory product. So our approach isn't to try and skirt regulation by somehow being unregulated. It is to eventually embrace regulation, get the licenses needed to operate, and where it makes sense, partner with banks, right? Fintech bank partnerships make sense in a lot of different ways, and I'm sure there are places or corners of that partnership that the regulators will put a spotlight on and put more regulation around, which makes sense as well. But our ambition is to be a bank. We're not looking to just be a neobank without a banking license.
All right. Thank you, Gabby. Thank you, Sid.